Stages of venture capital investment. If you remember, in the previous chapter, we said that venture capitalists invest in a business irrespective of the stage it is in. So, let's look into it in detail. Seed capital stage. At the very beginning, when new and high-tech ideas are tested in a small setting like a laboratory, these ideas usually come from research done by companies or science institutions. After successful lab tests, a prototype product is created to see if it could be made for real. However, investing at this point is risky and only a few venture capital funds are willing to do it. Early stage financing. At this stage, products aren't being sold yet, so money is needed to make things happen. There are two parts to this. First part is the startup stage. When a new product is about to start being made available for sale and a business receives venture capital money, it is startup stage because it's the beginning of something new. The product could come from a company's earlier research or technology borrowed from somewhere else. It should have a potential market and either replace something that's usually imported or be a completely new thing. People who do not have enough money for their projects can ask venture capital funds for money in exchange for a share in the project. These funds check if the person behind the project can manage it well before giving money. They can also help with the skills and experience to make sure the project succeeds. But remember, this stage is risky. First stage. This part is often called the emerging stage. In this phase, a company gets enough funds to make and sell the product. To really start selling, a good amount of money is needed, so the funding is usually more than what's needed in the earlier stages. Formative stage. This term includes both startup and the first stages. It's a bit hard to tell them apart because they're pretty similar. Instead of getting money in multiple small rounds, these stages are combined into a big round to make things simpler. Later stage financing. After a business is up and running, the owner might need more money, but they can't get it by selling shares on the stock exchange. So to raise more funds, it can opt for venture capital financing. Venture capital funds prefer this later stage because they expect to make money back more quickly. There are a few ways in which this later stage can happen. Second stage. In this stage, the company is selling products but hasn't started making a profit yet. They need more money to grow and become profitable by doing things on a larger scale. Third stage. At this point, the goal is long-term growth, like building a new factory in a different area. This needs a lot of money for marketing and expansion. Mezzanine financing. This is like getting money just before the company becomes publicly traded on the stock market. It's the last step before that big step. That's why it is called mezzanine. So these were the different stages at which venture capital may decide to invest in a business. In the next chapter, we'll explore the step-by-step process that leads to a successful venture capital investment.